What stage are we in the economic business cycle? So join us with the veteran technician Martin Pring, who's a specialist in this area, where he actually shares his latest perspective on what stage in the cycle we are in. Welcome, Martin. Wonderful to have you on our launch show of the Swiss Association of Market Technicians.
Thanks, Ron. Very nice to be with you.
And if, just for our viewers, where are you speaking to us from in the States?
I'm speaking to you from Sarasota, Florida.
Wonderful. We look forward to having you on the show, maybe in person someday in the future. But for now, if you could tell us a little bit, especially for those who are looking at your work early on, your approach and what it suggests about the business cycle conditions that we're in.
Are you going to be putting up the business cycle slide?
Yes, it's up now.
Okay, well, this is an interesting slide because what it does is it tells us that there is a set chronological sequence between the primary 10 turning points of bonds, stocks, and commodities. And that tends to arise because the business cycle is nothing more than a set series of chronological sequences itself. I'm sure everyone has heard of the leading indicators, the coincident indicators, and the lagging indicators, but those are indexes based on leading, coincident, and lagging components. So the business cycle itself goes through a set series of chronological sequences, as do the markets. So this diagram that we're looking at now basically pans out the growth path of the economy in terms of the growth path as opposed to the actual economy itself. And so at the beginning of the cycle, when we move into a recession, typically what happens is that the central bank senses that the economy is not too strong, and it starts to ease. And at the same time, we have credit demands begin to fall because we're in a recession. So the price of credit, which is interest rates, also falls. And of course, since interest rates and bond prices move in opposite directions, that sets off a low in the cycle for bond prices. After a lag, the players in the stock market begin to sense that this injection of liquidity into the system and the lower interest rates are eventually going to result in a recovery. So the stock market typically will bottom right at the period of maximum downside momentum in terms of the economy. It's also when the news is blackest, so that I'm sure you've often heard of the fact that we should be buying when the news is blackest. Well, that's the reason why, because the stock market is fully at that point discounted the recession and is looking forward to the next recovery. Then as we move through the cycle, the next thing to bottom out are commodity prices, because the demand and supply of commodities comes into balance on the demand side as we move into the recovery phase. So at that point, we've got bond, stocks, and commodities all rising. And like with all good parties, that must come to an end. And as the economy begins to get stronger, so the Federal Reserve is not giving you a tight money policy at this point, but it is starting to be less accommodative. And at the same time, loan demand begins to pick up. So the price of credit now starts to rise, and that's interest rates. So as we move, a lot of people think that the stock market now is going to peak out, but usually that indicates when you get the first rise in interest rates that we've got a healthy economy, which the stock market likes. But eventually, as we move to the maximum period of growth, stocks peak out, and then eventually the growth path starts to fall and commodities peak out. So we get this kind of sequence which takes place pretty well in every cycle. Now, sometimes what happens is, and what has happened in the current cycle, is that we don't get a recession. We get a slowdown in the growth path. So the growth path comes down to that blue line and then bounces off it. And this also causes the chronological sequence in these financial markets. So the whole business cycle typically lasts around 4 years from trough to trough. And obviously, we troughed in 2009, and now it's 2018. So we've had a couple of slowdowns in that period. One was in 2011, 2012, and the other was around 2015, 2016. So that really kind of sets it out. So you're probably going to ask me, where are we now in the cycle?
Well, where are we now? And if I may ask, Martin, have all of these exogenous influences in the market maybe changed the cycle in any way, shape, or form?
Well, we don't get this chronological sequence repeating in every cycle, Ron, and the leads and lags are different in each cycle as well. And as I mentioned before, we don't get the pure. Well, I wouldn't say pure, but we don't get a recession in every cycle. Sometimes we get these slowdowns, but we still get this chronological sequence sort of taking place even during the slowdown. So, in other words, the slowdown is kind of like when you're running a long race. You can stop for a while, catch your breath, and then move on again. And that's really what these slowdowns do. And we had that in the stock market in 2011, 2012, and again in 2016, where we hit that low at the end of the year.
Thank you very much, Martin, for joining us today on our SAMT interview.
Thank you, Ron.
And that's it from myself, Ron William, Vice Chair and Head of the Geneva chapter of SAMT, in partnership with Dukas Copy. We look forward to seeing you the next time.